And joining me now live is James Roberts, CFO of Time Finance. Ticker there is TIME, Time. James, thanks for joining me.
Thanks, Justin. Good to be here. Thank you for having me.
Yeah, and you've released some cracking results again, and you keep knocking it out of the park. But you've announced final results today, and also a Q1 trading update. Before we get into all this, James, and some of the sort of highlights, for people maybe not familiar with Time, can you explain, what you do as a business?
Yeah, of course. So Time Finance is a non-bank alternative finance lender. We provide funding facilities to thousands of UK SMEs all across the country. We're typically lend to the SMEs, so the smaller end of the market, the lifeblood of the UK economy, as we call them. We primarily lend on our own book, so we will look to do the lending ourselves to support those businesses through our core products of invoice finance or asset finance. We do have the ability to broker on, so if deals come our way and we can't help a potential client, either the margins are too thin or the risk isn't quite what we'd like to do, we can broker on to other funders. We've just finished, our financial year end is the 31st of May, so we've just finished our 4-year strategy, which we began in June 2021 through to the end of May, and published those numbers. And we've also, just as you alluded, published our Q1 trading update for the first quarter of our new 3-year strategy through to May 2028.
Yeah, well, just before, in fact, you can put up some slides. We'll go through the results here, but explain for people the difference, because I know part of the strategy was changing from doing a lot of brokering on deals to doing lending off your own book. Can you explain the difference between those two and the impact they have on your business and your profits, etc.?
Yeah, absolutely. So there's probably two strands to what we changed back in June 2021. As you alluded to, we decided to focus more on lending on our own book rather than broking on, and I'll explain what that is in a second. And also we decided to focus on secured lending more than potentially unsecured lending, and it's those two factors that have driven the results over the last few years. But broking on versus own book lending. Own book lending is pretty much what it says. We lend the money ourselves to the clients that we have, either through invoice finance or asset finance. So we're taking that risk. The advantage to that arguably is it strengthens your balance sheet over time, and we wanted to do that, and you get surety of income over the life of the lease or the loan, which typically is 4 years. So every month revenue drops in as they make their monthly repayments, and if you get your underwriting correct, and there's not many arrears or write-offs, that drops through to profit. So you get quite steady and growing profits. It's cumulative from own book lending. The flip side is broking on. That is where a deal comes to us. We don't write it ourselves, but we know other funders who do. So we pass that deal on to other funders who will take the risk, and we get a commission from that. So that gives you a short-term revenue and profit boost as you get the commission for introducing that deal. We used to, back in June 2021, don't wish to hark back too long, but back then when we set this in place, we did about 50-50 broking versus own book lending. We were both. We're now doing in the high 90s, about 97% of deals that come our way we do ourselves, and about 3% we broke on. So we will still broke on if the deal isn't right for us. Maybe the margins are too thin, or the risk is perhaps too great for us. In our underwriting, we think it's not a deal we want to write. There are funders out there who are specialists in a variety of things, and we will broke onto those for a commission. But we're very much focused where possible now on writing businesses, the right types of business, on our own book.
Yeah, absolutely. And so just quickly, I mean, going back, I don't know how many years, maybe 10, 15, 20 years ago, a business would traditionally go to their bank, traditional banks, the high street banks, for loans and all that. But that seemed to have moved away, and they've stopped. I mean, it seems like now traditional banks, are not interested in small and medium-sized businesses, well, to a certain extent. And this market, like alternative financing, is thriving, and it's happening in the US as well. Why is that? Why has it changed?
Well, I think it probably all goes back to 2008 and the financial crisis there, and that really, since then, it's never really recovered. I don't wish to speak ill of banks at all, but they do say they still lend to SMEs. But in my experience, it tends to be they provide funding facilities to the likes of ourselves, and we then lend on through to SMEs. So they're sort of vicariously saying they still lend on to SMEs. They still do to a degree, but not to anything like they did before. And with them stepping back from 2008 onwards, that created a vacuum that, as you're right, a number of alternative finance providers such as ourselves stepped into to provide funding to UK SMEs, because my view is we're quite quick to talk ourselves down, but actually UK SMEs are remarkably resilient, and there's some fantastic businesses out there, and with the right funding they can thrive and grow, or they can survive and see themselves through the difficult times. And so there's a number of funders, as I say, like ourselves out there, who will support the right types of businesses. We're relatively unique, not completely unique, but where we're relatively unique is we are a multi-product finance provider. So there's a lot of alternative finance providers out there who will say focus on invoice finance, or focus on asset finance, or focus on commercial loans, or focus on asset-based lending. We're one of a very small number who actually can do pretty much any of those. And so if a client comes to us, we think we're well positioned to be able to find the right solution for them and help them out. So yeah, we're one of a few who filled that gap as the banks have stepped back. But as I say, the banks do tend to provide the funding to the likes of ourselves to then pass on.
Okay, so I mean, the fact that they're doing that, I mean, they're never likely to step back into the market directly, or is there rumours that's going to happen, or what?
Not to my knowledge, I've not heard rumours of that. I think if you look at it from their point of view, and again, I'm speaking of other people there, so I could well be wrong, but they are getting a reasonable return by lending to people like ourselves, and the risk is far less to them because effectively they're lending to us, who are a bigger business and hopefully more well capitalized. And if some of our little deals go wrong, we can put other deals into the funding for them, so their risk is mitigated. I don't think they're looking to focus to come back into that area. If anything, when times are tough, and there's increases in write-offs or insolvencies or arrears or what have you, they tend to retrench even further. And that means the likes of us, there's more opportunities for the likes of ourselves to get bigger and better deals as they become even more risk averse. And that's not to say at all that we want to go up the risk curve and take on deals that we think are going to go wrong. That we're not in a race to the bottom at all. We're very conscious of risk and reward, and doing the right deals at the right price. But it gives better opportunities as a bigger universe to go out of companies.
Yeah. Okay. Well, let's take us through some of the slide deck here and some of the highlights of the year, and maybe quarter one if you could as well, James, please.
Yeah, of course. Sorry. So yeah. I touched on it now earlier. We've just finished our 4-year strategic plan. We came out of COVID, put a plan in place, and we think it's been 4 years of delivery. The key takeouts for that were we said we were going to roughly double our lending book. We were going to become a nationally recognised SME funder, and we were going to grow our profits and strengthen our balance sheet. And we think we've achieved all of those things with consistent delivery over the last 4 years. Sorry, my slide's being a bit slow. There we go. In terms of doubling the loan book, we can see at the end of May, our loan book was 217 million. That's 92% growth over the last 4 years. And our two core areas, invoice finance and hard asset, grew both by 176% and one by 236%. So there was some significant growth in the areas we were looking to focus on. And we see our revenues and profits have grown significantly. 117% increase in revenue over the 4-year period, and 117% compared to where we were in 2019, and back to profits of where we were before. The profits, however, although they're back to the same level, they grew from a £2 million low point in one of the years up to 7.9 million this year. It's very much different makeup. It is based on own book lending, as we touched on, rather than 50% being commission. And 50% being commission means every month you have to run very fast just to start generating the income. But being based on own book lending, as I alluded to earlier, it's compound, so that revenue keeps coming through month after month once you've done the deal. So we think it's much more robust and stronger revenue than perhaps it was in the past. And now, as we'll come on to Q1 results, we're growing beyond that as well. In terms of becoming a nationally recognised lender, we think we've done that. That's not to say Joe Bloggs on the street will know who we are. We don't do much direct business. You won't go onto our website and be able to get business through us. We tend to get businesses through finance brokers, accountants, lawyers, etc., like that. So through third parties introducing to us, and that's who we focused on becoming known amongst. We feel the brokers now know who we are, what type of deal we want to have, and they're aware of the focus we have on speed and excellent client service. So we're getting more and more deals coming our way from people who know who we are and what we want to do. We've also raised our profile by sponsoring the NACFB, hiring industry experienced people, and we've won a number of awards along the way.
Yeah, and as far as competition is concerned, like you said, that it's quite a buoyant market. There are other players out there. I mean, is there a lot of competition, or is it just a big enough market for everyone, for everything to go around?
Well, both of those points are true. There is significant competition. You're absolutely right. There's a number of other players who operate in the same space as us in asset finance, and a number of other players in invoice finance as well. There's very few who do both, but there are in each of those subdivisions there are competition, and we have to differentiate ourselves. And the multi-product offering and the speed of service and the flexibility that we offer, we think does put us in a relatively unique position. But yes, there is competition, and you've got to run pretty fast to keep growing. But also it's a big market. It's a huge market in the grand scheme of things. Although we've seen significant growth, our lending book's grown by over 100 million in the last 4 years. We're tiny in the grand scheme of things compared to the market that's out there. So if we can keep doing the right things, lending, the pricing and risk and reward, providing brilliant customer service, having multi-product offering, once people are aware of us and have worked with us, they tend to like us and stick with us. So without wishing to sound arrogant, there's an awful lot to go at there, and we like to think if we get in front of people, we've got every chance of winning the business. We want our competition to think, oh God, we're up against Time Finance here. These guys are the best at what they do, and the last 4 years have shown that we're doing something right anyway.
Yeah, absolutely. Okay, and take us through some of the figures.
So the last 4 years, as I said, have all gone pretty well. I've got some detailed slides here on the financial results. I won't probably go through all of them, but the four key takeouts are the year to the end of May was a record annual revenues and profit. The quarter to the end of August that we've also released was a record quarterly revenue and profit. We've seen 17 quarters of loan book growth over the last 4 and a bit years. Our balance sheet strengthened, but we've done it, we think, in the right way, in that we haven't seen arrears or write-offs increasing. They've been well controlled and in our target ranges. And so we think we're growing safely and securely, and it's continuing to grow.
Well, do you know what? When I discuss sort of time finance with other investors, and some people, they say, well, great performance, but they say, and they often question sort of, what if there's a recession? Or, what if interest rates go up or go down? So let's start with recession. And I've gone back with, listen, in the last, 3-4 years, the UK economy has hardly been flying. We are teetering on the edge of recession every quarter, pretty much. And so it's not as if we're booming anyway. So how does your business get affected by, where we are in the economic cycle?
Yeah, good question. And actually, I'll just skip to a slide later on, if I may. Just to have in the background. So on the right-hand side here, you'll see the movements in lending and the balance sheet and profits over the last 4 years, and you can see they're all going up. And I think that reiterates the point you made, Justin, in that over those 4 years, we've seen a plethora of different macroeconomic environment, and we still continue to grow. And that's primarily because a business like ours, we like to think, does well in times of boom and bust. In times of relatively benign macroeconomic environment, we'll do okay, but we won't set the world alight. But it's in times of boom and bust, if we've got businesses wanting to grow, we can provide funding solutions for them to invest in assets and kits to grow. And in times when it's tough and businesses need to be able to pay the bills each month and pay the staff, we can provide the appropriate financing solutions then as well. And we make no bones about that we help businesses thrive, but also survive. And there are an enormous number of very good UK SMEs out there. We're probably quick to beat ourselves up often about the state of our businesses, but there's some fantastic businesses out there. And if you can put the right funding and solutions in place, depending on whatever the macroeconomic environment is at the time, then there's some great businesses to fund. And that's what we've found. When things are going well, there's demand for growth. When things are not going so well, often people will go, well, I'm not going to buy that new JCB now. I'm going to redo the old one and keep it for another couple of years. And we're able to offer those refinancing options as well. So they can do the latter, as well as offering the financing solutions if they want to get a new one in the times of growth. So I don't wish to be flippant at all. A recession is never a good thing. But for somebody like ours, we don't think it's the end of the world for a company like ourselves. It will provide opportunities. The key is picking the right opportunities, getting the right security in place if deals do go wrong, because it's a lending game. Some deals do go wrong. Getting the right security in place, and then the opportunities are very big for someone like ourselves in either times of boom or bust.
Yeah. Well, I said, a key to your success is evaluating the risk and all that stuff. And in fact, you've probably got a slide on the deck here. But can you go through, for example, like I said, the arrears, it's been stable for many years. 2 years now, 5%. But that's arrears. But write-offs is still at 1%, isn't it?
Yeah, that's right. Hopefully the slides come up here now showing this. I mean, on the left-hand side, we've got a little graphic showing the arrears from when we started our initial strategy in May, June of 2021 through to the end of August. And on the right, there's a table there which shows the bad debt write-offs. Without wishing to teach people to suck eggs, if you could humour me for just 30 seconds if I explain the difference. Arrears are just deals that are not performing to plan. Now, that could be anything from, I don't know, somebody's gone away on holiday and they forgot to pay their monthly repayment, and we pick up the phone and they pay us in the next 24 hours, all the way through to ones that have not working for a variety of reasons, and we're in the legal process of trying to get our money back. So arrears is not, doom and gloom. It's just an early warning indicator. If arrears were spiking, that could lead in time to write-offs, because you're not going to get them all back on track. We have a pretty good cure rate of getting a number back on track, but some will end up being written off. So arrears is key to look at to see what's likely to happen in the future. And what you can see on this graph here is the purple line is across the group. The green dots is hard asset, and the blue sort of dashes are invoice finance, which are our two key growth and core areas. And you can see all of those have come down over the last 4 years. At the group level, it was in the sort of 12-13% back in 2021, and it's been in the sort of below 6% now for the last three years or so, and around about 5% for the last 18 months or 2 years or so. And so you can see the arrears are not spiking. So the fact we've grown the book, we've done it, we think, in the right way. We haven't put deals on there that are going to lead to a load of trouble down the line. Write-offs, however, are different. They are the ones where you've not been able to cure the arrears, you've not been able to get them back on track, and unfortunately you had to take a hit, if you like. But you can see here the arrears are around about 5-6%. The write-offs have been at 2 or 1%, and for the last couple of years they've been at 1% of the book. We operate in what we call the tier 2 market, which is, it's not the blue chip companies in tier 1, or it's not the subprime companies in tier 3. It's in the middle. They're story deals. So some of them will go wrong. It's just the nature of the beast. But the key is in the security you've got, and you can see there between the arrears at 5 or 6%, they're either cured or we've got security in place where we get our money back. And the end hit, if you like, at 1%, we think in the sector we operate in is acceptable. If a write-offs can ever be acceptable, they're never going to be none. So 1% we think is in our target range of 1 to 2%, and we see no reason for that changing.
Yeah. And I suppose a key to this as well is being sort of diversified, isn't it? And across sectors, across businesses, not having too big a loan in one company. So I mean, that's another sort of risk that people state, saying, yeah, but what happens if one of the big loans goes wrong? So I assume you don't have any one-off big loans to one company, do you?
No, a phrase Ed, our CEO, regularly uses is "don't bet the ranch," and we live by that. We will, even if it's a great deal, if it's too big, we won't do it, because even if it's a very, very slim chance it goes wrong, it could really hit us if it's too big. So we have a very strict credit policy of what we will lend and what we won't lend to. And this graphic here, hopefully you can see, shows that this is showing our lending book by the sector that we lend into. You can see there the largest is freight transport. No one sector then above 13%, and the top 10 there, you can see by the 10th largest sector is 1%. So the top 10 of our lending is less than a third of the overall book. So we think we're very, very well spread. And the rationale behind that is exactly that "don't bet the ranch" thing. If a big deal went wrong, it would obviously be a pain, but it wouldn't be the end of the world. And even if a particular sector had a huge downturn, again, it would be a pain, but it wouldn't be the end of the world. And so we're very focused on getting the spread right. We've always maintained well diversified lending. And sorry to labor the point, we're not going to bet the ranch. Our largest client facility in invoice finance is 2% of our book, and we're not going to go above that. So yeah, we think we're very well spread, and that in itself, being well spread and diversified, does just mitigate risk by the very nature of that.
So say a company came along and they wanted, they were going to be a big client, but it was too big for you. You wouldn't lose that? You'd broke that on to somebody else, or what?
Yeah, good question. So one, you're absolutely right. If it's just too big and it was one lend, we could broke it on and get a healthy commission in that respect. If, for example, it was a client that needed a lot of individual assets, theoretically you could break it up and you could go, well, we'll fund, let's say our limit's £1 million. We'll fund £1 million worth of diggers in my made up example, but they want 2 million. We could then work with a funding partner that we know who could fund the other £1 million worth, if that makes sense. So we wouldn't necessarily turn a deal away. There are a variety of options that are available to us of trying to work with that client to get that funding done. There will be the odd one, if someone came along and said we want £20 million, and then even if you spread the risk, spread it with other lenders, we're probably not going to be able to do that. But there are different ways to skin a cat, and so we'll look at every deal within reason, and there may be ways to structure it so that we can help.
Yeah. One other thing I sort of touched on, people mentioned about interest rates and how that affects you. So, we are now, I think they're not expecting interest rates to come down any further this year, I don't think, but you never know. But we are on that path, as I say, is downward, trajectory. So what happens to the time finance, model business when interest rates go lower?
So we've structured our business so that we've got effectively a natural hedge. And what I mean by that is we've got invoice finance and asset finance are roughly the same size. We can't keep them exactly the same size, but within reason they're the same size, equal split, hard asset and invoice finance. And interest rates affect them both inversely. So when interest rates go up, that's good for invoice finance. They make a bit more money. On the flip side, it's bad for our asset finance because our funding, the way we're funded and things like that. But the flip side is when interest rates go down, that's good for asset finance and not quite so good for invoice finance. So if you keep them at roughly the same size, they're a natural hedge against each other, which is very much a way we've deliberately structured the business so that we're not completely indifferent to interest rates, clearly, but to a degree, they offset each other whether they go up or down. So the last couple of years with interest rates going up have been very good for invoice finance. And that's because they lend more than they borrow from the bank, so they make a little bit of a margin on the increase. It's been a bit tougher for asset finance, but now they're coming down. We'll see that going slightly the other way.
Yeah. And as far as diversity, your funding partners, I know you loan some off your own, own cash, but I mean, your funding partners themselves, you've got a sort of there we are, sort of 1, 2, 3, 4, 5, well, quite a few of them, and
yes. And that's a deliberate thing. Some people jump into bed with one funding partner, have a massive facility, probably a little bit easier to administer, if I'm honest. There's advantages and swings and roundabouts to everything. We like having a very well diversified funding partners, because if for whatever reason, and it can happen, you fall out with each other for whatever reason, you don't want to then have to refinance £250 million, which is what we've got in funding. We've got a subs bench of funders who are keen to work with us, ready to go, and we can just swap one in with the other. So we have a very well diversified funding panel, also because some funders, as you'd expect, like certain things and not other things. So some of these guys say we won't fund for whatever reason, like, for example, they don't want to do deals in Scotland. Some of them do. So you need a number of funders so you can keep with that national geographic spread of where we're willing to lend to. So we have a number of funders. Most of them have been with us incredibly long time, incredibly supportive. They've grown with the business. I won't name which one, but one of them, I can remember when I started, we had a £5 million facility with one of the names there. We've now got a £30 million facility with us. So over the years, that's grown and grown and grown. They're very flexible. Crucially, they don't tend to have non-utilisation fees. So you can see up there, we've got the best part of £100 million headroom. that's not costing us, 0.75 or whatever percent a year to not use it. They don't have non-utilization fees in the way we've done it, so that it's good to have that firepower. We try and be ahead of the game and sit there and go, what funding do we need for the next part of our plan? So we've looked ahead to May 28. We've tried to get the funding in place now so that all other things being equal, we have the funding in place, surety of funding for our 3-year plan, which is what we've got now. Now we'll constantly look to tweak it and change it and improve it if better options come along, but we can comfortably say we've got the funding in place through to May 2028. What we don't want to be doing is a load of deals come our way and we're scrabbling around for funding, and you for whatever reason there's a delay or something and you can't do a deal. That would be dreadful. So we've always got significant headroom to grow into over the next 1, 2, 3 years.
Yeah. Well, let's talk about because Q1 trading update out as well. Another strong set of figures. It seems like it's more of the same, which is excellent for investors. But how do you see it panning out? 'Cause it seems to be, really decent growth, but it's almost like you've got yeah, hand on the tiller there, steady, same thing again for the next 3, 4 years.
Yeah, I mean, so our plan through to May 28, which we've come out with, is we've said we want to continue growing the lending book. As you see there, it's about 220 million pounds at the moment. We want to get it to 300 million. So it's about 200 million relatively recently. So when we launched the strategy, so it was to grow it again by 50%. We've said we want to get our focus as well as very much on margins and efficiency. So we want to get our PBT margin up to the mid 20%. So it's not shooting the lights out, but in the current environment, we think steady, secure growth, 50% growth in the lending book. You can work that through to see the profit, especially if the margins are 25% plus. PBT will be significantly higher than the 7.9 million that we did to May 25 by the end of that 3-year period. And we think, arrears remain controlled and the balance sheet will be significantly stronger, with tens of million extra coming in to strengthen the balance sheet. So we think when we roll forward to May 28, again, all things being equal, it's an ever stronger and hopefully more appealing to investors' business.
Yeah. Just a question also on budgets and stuff. I mean, when the budget came out, the last budget came out, did you see any effect from businesses? Did you get less loans or more loans, or what happened?
It was pre the budget. It was sort of in the period we're in now. We saw a big slowdown, I think, because of the uncertainty. So I think people, if we use my slightly facetious example, someone's looking to buy a new digger or whatever. In this period from when the government announced that the budget is going to happen in November and people are thinking, well, what are they going to do? People would delay that asset purchase to see what was going to happen, whether they could make it after the budget or not. And we're in that period now where there is a little bit of delay in people making decisions because they want to see what will be said in November. What we found last year, and we're probably thinking the same at the moment, is within reason, once they've said what they're going to do, it gives people that certainty and surety of the next 12 months. And then they make their purchasing decisions either to hold fire, maybe refinance and redo the kit they've already got, which we can help in, or actually we can buy that new kit and grow. And again, we can help in that situation. So there was a little bit of a lull for the 3 months before the budget last year. We're sort of in that period again now. And then it actually, perhaps surprisingly, but it kicked on after the budget was announced, and fingers crossed that will happen again this year.
Yeah, but even so, I mean, you've already come out. I mean, it won't be 8 months until year end for 26, and you say your results are going to be at least in line. And what I like about you guys, you do tend to underpromise and overdeliver. I mean, I was looking back. I think in the last since I don't know the last 3 years, you've done about 6 or 7 times ahead of expectations results. So you do tend to. So you must be quite confident to already be saying at least in line.
Well, as you say, you stole the words from my mouth. Under promise and over deliver. We never want to be in a position where we're giving bad news to our shareholders. So we think the numbers that are out there are challenging, but they're achievable, and we're pretty confident with the way things are going, all other things being equal, that we'll be at least in line with those come the end of May 2026.
Yeah, and I suppose, like you say, lending off your own book. I mean, it's unlike brokering on deals. Then you just have to run like crazy to keep up with the forecast because you've got a lot of recurring sort of income, haven't you?
Yeah, we've got about 27 million pounds of revenue stored up on the balance sheet. That assuming, and the key behind all of this is the deals work as you expect. So that's why the arrears and the write-offs are so key. But assuming they work as expect, that 27 million will drop in monthly over the next, on average about 40 months. So we've got quite a lot of income that each month will drop in from the book. As I say, 27 million or so sitting on there at the moment of future revenue. As long as the deals work to plan, that revenue's in the bag and it will come in. So that does give us quite a bit of visibility to make, we think, reasonably reliable forecasts going forward and come out, as you say, with the statement that we think will be at least in line, even though there's still 9 months to go.
Yeah. Well, you'll probably beat those, I think, just judging by the previous results come out. But James, it's good to chat to you. Thanks for catching up, and hopefully we'll catch up in the not too distant future. Thank you very much.
Thanks, Justin. Cheers. Thank you very much.